How is everybody doing? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, I wanted to talk about a blog post that I saw in PCBB about the recent stress test results. I thought that this deep dive was very interesting, and I think you will as well. So let's look at this article here. So this, if I could pull this up. So this is from the PCBB. This is from their BID daily newsletter from July 17th. But this was titled, Key Factors Behind Lower Losses in the 2025 Stress Test Results. So a deep dive into three major factors that contributed to a smaller than expected capital decline in the 2025 stress test and their broader implications for banks. So, and now I'm going to run through these three items real quick, and then we'll go back through them. So number one was less severe scenario due to countercyclical design. So very interesting. And there's a pretty good chart here. Number two was revised measure of private equity exposures. So we'll go through those items. And then number three was the higher net revenue from improved bank performance. And then at the end, it has some key takeaways here for banks, but we're going to go through all three of these here real quick. So let's see here. So in the case of the Federal Reserve's 2025 stress test results, they also came as a surprise, the good kind. Capital losses were smaller than expected due to three primary factors: a less severe recession scenario, revised private equity exposure measurements, and higher net revenues from better bank performance. These changes signal a shift in how the Fed assesses banking resilience and offer valuable insights into the future of stress testing, insights that banks can use to anticipate how upcoming regulatory changes might affect their operations. So again, number one, less severe scenario due to countercyclical design. So the 2025 stress scenario was less severe than last year's, which had a significant impact on the capital ratios of banks tested. The unemployment rate bump was also smaller for the 2025 scenario, 5.9% versus 6.3% in 2024, and both commercial real estate and housing price declines were moderate. The Fed's decision to apply a countercyclical design to this year's stress test was meant to align the test scenario with current economic realities rather than assuming a worst case scenario. So, and there were three parts to this. So impact on test results, regulatory implications, and why it matters to banks. So the impact on test results. So the less severe scenario resulted in fewer loan losses. More banks were able to absorb stress without falling below minimum capital requirements. In fact, the aggregate common equity tier 1, the CET1 capital ratio for the 22 banks in the stress test fell by just 1.8%, much less than in previous years. The regulatory implications. The new approach indicates that the Fed is shifting to a more balanced and flexible stress test framework that takes into account evolving economic conditions. The countercyclical nature of the 2025 test may be here to stay, which would make future test results more predictable and less volatile. Why it matters to banks. So while banks are not subject to the Fed's annual stress test, for big banks, understanding how countercyclical design is shaping regulatory framework can help banks align internal scenario planning and capital buffer strategies with the broader regulatory trends. So we have this very interesting chart here. Figure 2 is aggregate maximum decline and stressed common equity tier 1 capital ratio severely adverse scenario. And so you can see here, this measures over the last 6 years. And, 2020 was at negative 2.1, 2021, negative 2.4, 22, negative 2.7, 23, negative 2.5, and at 24, negative 2.8. This year down to just a negative 1.8. So each bar represents the aggregate maximum common tier 1 capital ratio decline of the banks in each exercise. So in other words, you get hit with a severe recession. What are the effects of that? You have a ton of loans go bad. How do your capital buffers react to that? What is there? How does the bank survive this worst case scenario, if you will? So basically much different, much more moderate scenario here. And again, banks is, there was still an impact. So it's not to say that there wasn't an impact on the banks here. It's just that they went with a more moderate scenario, what they're calling more, realistic based on the current, market. I'll have a little bit more to say about that at the end, though. But let's keep rolling here. So, revised measurement of private equity exposures. So this year's revised treatment of private equity exposures was also notable. Previously, private equity losses were included in the global market shock component of the stress test. This year, the Fed removed private equity from this component, projecting losses in the most adverse macroeconomic scenario instead. This change was designed to reflect the long holding periods of private equity, which is generally managed in banking book positions, not actively trading. So what is the impact on the test results? So the revised treatment resulted in lower projected losses from private equity, contributing to the smaller than expected capital decline. By moving exposures into more relevant scenarios, the Fed ensured that the annual stress test more accurately reflects the real risk profiles of private equity investments. What are the regulatory implications? By aligning the annual stress test with the actual characteristics of different investments, the Fed is aiming for more accurate capital planning and scenario analysis models across the U.S. banking system. Now, why does this matter to banks? Well, banks with exposure to private equity or considering investments in PE or other long-term illiquid assets may benefit from understanding the Fed's refined risk modeling. While the rule applies to large banks, it offers helpful guidance that banks can use to sharpen their internal assessments. So yeah, this part of it, I actually like this a lot. I agree with this. Moving the exposures into a more relevant scenarios. The Fed has ensured that the annual stress test more accurately reflects the real risk profiles of private equity investments. So this one I totally agree with. This one I think is a good move. And then finally, the last one, number 3. So higher net revenues from improved bank performance. So the 25 stress test also revealed a stronger banking environment with many banks showing improved profitability, driven by higher net interest and capital market activity. This uptick meant banks entered this year's stress test with more pre-provision net revenue, PPNR, which helped absorb losses and contributed to the smaller capital decline. So what was the impact on the results? Well, with a more profitable baseline, the stress test revealed that banks were well prepared to withstand losses. Stronger performance was observed in sectors such as credit cards and commercial real estate, where banks had improved risk management and were better positioned to handle defaults. What are the regulatory implications? Well, the Fed's models are clearly becoming more sensitive to recent performance trends, rewarding banks that maintain consistent profitability. This suggests future regulatory frameworks may place more emphasis on recent earnings, making profitability an even more important factor in future stress tests. Now, why does this matter to banks? Well, by focusing on enhanced net revenue, banks can build stronger capital foundations to withstand economic headwinds, especially as regulators place more weight on performance trends. So I'll come back to this one in a minute. So what are the key takeaways for banks? So with a less severe recession scenario, revised treatment of private equity exposures, and stronger bank performance, this year's smaller than expected capital declines are a welcome reprieve. For CFIs, there are several key insights to consider. Benchmarking and strategic planning. So banks can use insights from the stress test results to benchmark their risk management practices, especially in capital planning and economic scenario analysis. Anticipating regulatory direction. So stress tests offer a window into how the Federal Reserve thinks about risk and capital resilience. Even if banks are not subject to these specific rules, new guidance often trickles down. And then better competitive positioning. So this year's results will influence the behavior of larger competitors. Stress test results can signal near-term market dynamics that CFIs need to anticipate, such as capital availability, loan pricing, or investor sentiment. So again, I agree with all that stuff. Yeah, this really helps with benchmarking and strategic planning, anticipating the regulatory direction, and better competitive positioning. So yeah, all 3 of those things are absolutely spot on. So true. Very good. Here's a couple of things that I would just note, though. So when the economy goes bad, right, and your loan portfolio is going bad, you have 3 layers of defense. You have your profits, you have your loan loss reserves, and then you have your capital. You have your capital base. So those are your 3 layers of protection there, right? And you have, so usually the first thing that goes when the market goes down is obviously your profits. Your profits go out the window. Then you have to tap into loan loss reserves, and then your final stand is your capital. And obviously, if your capital gets wiped out, it's game over. But as we found out in a lot of the bank failures in 2023, that just the good old fashioned run on the bank. Liquidity. Liquidity is enough to wipe you out if you lose your liquidity. So it's very interesting. Like I said, some of the things I really agree with. Obviously the private equity changes, I like that. Basically putting things in the appropriate categories and moving things around is obviously really good. Nothing wrong with that. So that's a good thing. Giving banks a little bit more for a little bit more credit maybe for their revenue position or their profit position, okay, but then kind of I don't know, I'm not sold on this moderating of the worst case scenario. I mean, the worst case scenario is the worst case scenario. What happens if things fall apart? I mean, I think what the answer might be, and what I would probably rather see, is perhaps both sides of the coin, right? Yeah, let's do a more moderate case scenario based on where things are at the time that you conduct the stress test. Fair enough. But there should also be a worst case scenario there too. We should also see, okay, when you're looking at this, for example, you might go, okay, given how things are in a more realistic take, banks might only, the percentage point drop might only be 1.8%. However, in the worst case scenario, things are really horrible. Banks are probably down, 2.8%. So, and I think if you just have both those things to look at and judge, that I think that helps perhaps paint the best picture to give you an idea of where things are really at and what's going on here. So it's very, very, very interesting stress test results. I really appreciated this deep dive here from PCBB, giving us some really good information on the recent stress test results here for 2025. I thought people would find this rather interesting. So, but with that being said, I'll wrap up by saying, if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I love getting back to everybody. And as always, check out some of the other content on the channel. I hope everyone has a great day out there, and I will see everyone again real soon. Thanks a lot.